So, okay, gold mutual funds. Um, Currently, there are no silver mutual funds, and the reason why is there's just not enough. Um, Large caps and large mid tiers. There's only 18 silver miners that produce more than 1 million ounces. So, you're only looking at maybe 10 large silver miners. So no one's tried to do a mutual fund. Um, they mix them, but just all silver companies are primarily, currently there aren't any. That's why SIL and SIJ are kind of unique. Typically mutual fund, like an ETF, has about 30 to 50 stocks in it. Some of these funds include silver miners. Some do not, so you have to check. Some of them include platinum and palladium, so check the prospectus. Benefits, professionally managed, which lowers the risk for you. Can be good income stocks. The one thing I like about mutual funds, which I didn't originally, is they pay out annually any gains, any capital gains, and any dividends. You can reinvest it, but you have to pay the taxes on it annually. But it makes for a good income stock. So let's say that you have a gold mutual fund and it goes up 25% in 1 year. You get paid that 25% that year. So it's basically a good income stock. So you get paid out annually instead of over time. So you don't get, it's a short-term capital gain. It's not a long-term. So some people consider that as a negative, but that's the benefit of a mutual fund, is like the income. You can get a really good check every, if a good year, like I said, it goes up 25-30% in a year. You can get a really good check at the end of the year. And the dividends tend to be pretty good as well. They tend to focus on them. They trade just like stocks, although they don't price like stocks. They get priced at the end of the day. The NAV doesn't update during the day. If you buy a stock during the day, you actually pay what it ends up at the end of the day. So if you buy in the morning and then it goes up or down during the day, it's whatever it ends at. They tend to be highly liquid, just like a stock. The drawbacks, high premiums. Um, they're usually, the premiums are usually around 5%, whereas an ETF, the premiums are tiny, like 1% or less. So if you buy a mutual fund, you need to go up 5% to break even. Some people don't like that. And they also have high annual fees, at least 1.5%, sometimes 2.5%. So those two factors right there is like, well, I don't want them. And that's why a lot of people say, I don't want mutual funds. I don't want to pay those high fees, annual fees of 1.5%, 2%. No, thank you. But from an incomes perspective, if you like income, I think they make a lot of sense. I have 3 gold mutual funds, and they pay out in December and right at the year end. And I actually like getting that income. I like, originally I didn't like it. When I actually bought my first mutual fund, I didn't realize that they didn't have long-term capital gains, that they paid out annually. I said, what? I don't, I want this thing to get big, but then I got used to those checks every year, and now I like it. They may not match your investment objectives. That's like an ETF. And you have to pay taxes annually. It says pay capital gains annually, but that's a short-term capital gains, not long-term. Even if you reinvest the gains, you have to pay it. One thing you have to be aware of is if a mutual fund loses money, they can have a carryover loss. If it's a bad year, and then that payout can drop for the next couple of years where you won't get paid. That's one of the negatives that I learned about mutual funds, is this carryover loss. In other words, you don't benefit from the carryover loss, the fund benefits. And so I thought that's kind of messed up. You will benefit if your NAV goes down, and then if you sell at a loss, of course. But the tax losses for the company, it actually benefits them, that carryover loss. It probably benefits you in some degree, in some way, but that's just something to be aware of. You might check to see, if you're going to buy a mutual fund, check to see if it does have a carryover loss.